I gotta be honest, and I thought I'd never say this. Actually, I never thought I'd even think this, but was I wrong about Trump?
Democracy is at risk.
President Trump is defending his aggressive tariff policies. They could plunge the country into a recession.
Inflation has started to move up now, we think partly in response to tariffs, and there may be delay in further progress. Uncertainty around the changes and their effects on the economic outlook is high.
I mean, I knew the economy and I knew the markets were in for it, but holy crap, I didn't know it was gonna be like this. I mean, this is happening fast. Inflation is gonna go up because of the tariffs. Interest rates are still elevated and they're crushing businesses. The stock market is literally on the verge of collapse. And Trump's trade wars, heck, we can't even figure out what direction he's going. Is there gonna be a tariff? Is there not? Is this part of a bigger plan? Is Trump trying to reshape the entire United States? Is this really Trump-pocalypse?
America is back.
I'm Chris Naugle, and this is another episode of What Now? What's next for Trump? So first of all, tariffs. I mean, Trump's tariffs, which have been very confusing, have pushed the stock market to the edge of correction zone. I mean, literally, we were in correction zone. We've come back a little bit, but are we gonna stay here? Probably not. So what we gotta do, if we're gonna really look at whether or not I got this all wrong, we gotta kinda take a trip back. And we gotta look at all of the data. Because we've gotta look at the tariffs, we've got to look at all the stuff you're seeing in the media. And, I seriously, when Trump came in, I'm like, okay, things are going to get better. The media situation is going to get better. We're not going to be lied to nonstop. We're definitely going to see a better economy, and the stock market's going to start doing better. That isn't exactly what's happened. So when we dive into this, the first place in this investigative report, if you will, is a stop off at the bank. The central bank, that is. So the way I look at it, the Fed has two choices. Number one, they can cut rates, which is what Trump wants. They can cut rates, which is going to be inflationary, so they say. So if they cut rates, inflation probably goes back up. Or do they hold rates, which means the stock market's going to go down? Because the markets want rates to go down. The markets are already showing signs of stress. If the Fed doesn't step in and do something, I mean, we're already at the brink of a complete collapse of the markets. What's up, Mr. Fed? What's up, central bank? What are you going to do? They went on and said, we're going to hold rates. And, well, the markets don't even know what to make of that, but they don't like it. But they're looking past that to where the Fed said, hey, what we're going to do is we're going to probably look at maybe dropping rates up to 2 more times this year. In this chart, all I want you to look at is all those little lines going straight down with the gray in the middle. Those are recessions. And if you look at this blue line, that is the Fed funds effective rate, effectively interest rates. What happened every time before? Well, back in the late 50s, right here, they went up and there the market fell. And they went up again and the market fell. Whoops. But then as we go through the 1970s, you can see they were really jumping rates up really quickly. And then all of a sudden, all hell broke loose. Same thing happened in the mid 70s. They jumped rates back up and it spurred another major sell-off in the markets. And it happened again in the 80s. And 80s were crazy. If you remember, the interest rates were way up there. Look at these numbers. I mean, you got 15% interest rates. What did that do? Hurt the markets. Again in the 90s, same thing. Try to raise rates, up, sorry, not good. And again in the early 2000s, right before the dot-com recession happened, I remember this one very well, they were raising interest rates. And they did the same thing again right before the Great Recession. They did the same thing again right before the pandemic, although not correlated. And then what are they doing now? Look at that sucker. That is a roller coaster ride up. And what comes after a roller coaster gets to the top? Woo! Or somebody pukes and it goes in your face. Yep, that's about what it looks like is going to happen. So what's the conclusion? Well, the conclusion is the Fed going to come in and save the day? Because I think that's what a lot of folks think. Oh, the Fed's just going to come in and they're going to save the day. The decision they just made didn't seem like that was a save the day Superman kind of thing. It was kind of like, nope, we ain't doing it. Nope, we're not complying. Nope, we're not going to help the markets. The This is a doozy. Routers put this one out. Stocks fall, adding the biggest sell-off in months on economic fears. Oh, but it keeps getting better. Here's our boys and girls over at Motley Fool. Stock market sell-off. Will the Federal Reserve step in with interest rate cuts? Nope. High interest rates, we pay for inflation into the future. You see, when you have high interest rates, we pay for it now. But when you have inflation, we pay for it for a long period of time. And right here, look at the correlation. Inflation and interest rates. There you go. CPI is the blue, 10-year Treasury is the orange, small business rate is the gray. Can you see what I'm seeing? Yeah, we're going to pay for this, folks. You see, the payment just started. While the Fed is trying to fix all and be all and soft land this thing, there's a much bigger problem on the horizon. One that literally will rattle the entire financial industry to its core, and that is the commercial loan cliff that we're about to go off. You see, let me explain this a little bit. All of you probably remember the pandemic. During the pandemic, everything got shut down, and everyone eventually started working from home because, well, we couldn't go to work. Well, all those big buildings that people used to work in, those are the commercial real estate buildings I'm talking about. You know, the ones that are pretty much vacant today. I know they've done a really hard push to get people back to the office, but there is still a massive amount of people who are working from home, doing a good job of it, and being like, I don't want to go back in the office. When those commercial buildings were bought or refinanced during or around the pandemic time, they were bought with really low interest rates. You remember that? It was like a fairy tale land. You could get a mortgage on a commercial building at like 3 or 4%. It was like, holy crap, we're going to make a bloody fortune. But what you don't know about those mortgages is almost every one of them had a rate lock period. Now that rate lock period, depending on the deal or the bank, was 5 to 10 years. So what does that mean? You're pumped. You just got a mortgage. You bought this commercial property. You're going to make a ton of money, and you're going to make a ton of money because your interest rate is 4% for the next 5 years. Then after that, it's a variable rate, and it's going to reset or refinance in some cases at the current rate. So just do the math with me. 2020, 2021, 2, 3, 4, and 2025. The first year that we are really going to start to feel the impact of this, because now those commercial mortgages are going to reset. People in the 10-year, they might be okay. But where are interest rates now compared to where they were? Even though we've come down a little bit on interest rates, it's still double. If they were at 4, they're probably going to be at 8% now. What's that going to do for their cash flow? Oh, it's not going to be good. But what's it going to do for their cash flow when there is no cash flow? People didn't come back to work. And the leases for many of these commercial buildings, although they're still paying the leases because these are big companies, their leases are coming up. Lease ends, they don't renew, rate goes up. Woo! So what does this mean? Well, this means that businesses are going to face a lot of problems. And what businesses? Well, the commercial real estate businesses, because now when these reset, the rate's going to go up, which means the cost for that mortgage monthly is going to go up. But their income doesn't seem to be going up because they're having a hard time filling these commercial buildings. You see it all over the news. You can just Google it. Look at how many vacancies these commercial buildings have. But hold on. Remember everything I talked about a second ago? We're like right on the brink of the economy going down. We're right on the brink of the stock market going down. Hell, we're in correction territory. So if the stock market falls and the stock market goes down, what's going to happen to the price of these commercial buildings? I mean, what's already happened to the price of these commercial buildings? They've gone down. Because who wants to buy a half-empty building? Not I. Who wants to buy a half-empty building that has gone down in value? And the people selling it, they got a mortgage that's still way up here because it was way higher in value than it is today. There's so many things wrong with this equation, and none of them end well. You know, actually, to Trump, because I know I'm kind of questioning this whole Trump thing, this Trump-apocalypse, okay? Did we make the wrong decision? But you know what? Maybe not. because maybe he saw this all along. He is a commercial real estate guy. He kind of knew what was going on. If he forces a recession, okay, with these tariffs and these trade wars and all this stuff, if he forces that, then the Fed, in my opinion, would have no place to go except for dropping interest rates. And if they drop interest rates, Trump would kind of be a hero. I mean, people definitely, well, I know Trump will be like, mighty Trump in the one who dropped interest rates. No, the Fed did. I mean, they did it because of your hanky-panky with these tariffs and trade wars, but I mean, come on. I mean, sure, Trump, take credit for it. Why not? You take credit for everything else. But check this out. Enough of the nonsense. Here's your proof. Delinquency rate on commercial real estate loans. Now, this excludes farmland, of course, but these are domestic. There you go, look at it. What's going on? Delinquencies. Remember in 2008, the Great Recession? Look what happened after that. Now, they dropped interest rates after that, but look what happened to delinquencies during that period of time. Whoa. Yeah, see, during a recession, delinquencies went way up. But then they dropped rates very low, and after that, 2010 down, interest rates went down, down, and down, and because they did, delinquency rates went down. See how that works? Interest rates go down, delinquency rates go down, kind of trends with that. But what's happening right there on that chart? 2024. Now, I know it's a bit early. I know we're a bit early to the party, but hey, better early than late. That looks like it's starting to go up. I gotta tell you, I think that looks like it's going up. CNBC came out with this one. The battered bond market starts 2025. Oh, CNBC's calling out. They're facing some difficult issues about debt. Well, what debt are we talking about? Ooh, this is getting good. Well, nearly $3 trillion of U.S. debt is expected to hit maturity in 2025. Told you so. Yep, expected to hit maturity in 2025. Much of it is in short-term nature. I love how CNBC does that. They nail you, they kick you in the stomach, but then like, oh, but it's just short-term. So as we get into this article, and I don't want to beat this to death, but right here, the bond route in 2024 wasn't bad enough. Fixed income investors. Now remember, a lot of these commercial buildings are wrapped into bonds, okay? So I'm trying to get your head to understand that we're talking about the same thing here. Multiple challenges in the year ahead, including one under the radar, worry about short-term note maturings. Yep. $3 trillion of U.S. debt is supposed to hit maturity in 2025. And a lot of that, it's the short-term stuff. The Treasury Department's been issuing a large amount over the past few years, and the government's expected to try to lengthen the duration of these debts or roll them over, but who's buying? I know you're reading this and you're just like, I don't understand how this all ties in. Well, it ties in perfectly. So the U.S. government issues bonds, okay? And we buy those bonds, countries buy those bonds. It's like me lending money to the U.S. government, and the U.S. government says, hey, in this 2-year bond, we're gonna pay you back all your money after 2 years. But during the period of time from now till 2 years, we're gonna pay you an interest rate of, call it 4.5%. So what this is essentially talking about is, the short-term nature bonds, which would be 2 years and under. And then there's longer-term bonds too, like 10 and 30-year treasury bonds. Now, they don't need to be paid back for 10 or 30 years because the government's kind of got time on those. But these shorter-term ones, well, these pose somewhat of a problem because of what I said, the $2 trillion budget deficit. When bonds are maturing, the government certainly wants to kind of put them back out there. They want to reissue them. They want to roll them over. They don't want to have to lay a bunch of money out. But I know some people who probably will not be renewing those bonds.
Let's say China.
So essentially what this means is that businesses won't be able to afford new loans. And if that were to happen, defaults more than likely will skyrocket. And the worst part about all of this is government bonds are maturing at the exact same time. It's kind of like a trifecta or a dualfecta or a Trumpocalypse. So to sum this all up, what happens when the financial system starts to break down? Yeah, a recession. Could a recession actually be a good thing for the average American? At first you're thinking, no, recession bad. Yes, it is. But it's actually a path through. I read a book a long time ago that was called The Obstacle is the Way. This is the obstacle. because prices are just too high. And how do we get prices down? There's pretty much one way: deflation. And deflation typically happens during a recession because people can't afford to buy goods and services. It's the old demand and supply. Okay, if there's supply but there's no demand, what has to happen? Price has to meet demand. The consumer price index, the demand is going down right now. As a matter of fact, the funny thing, and I did another video on this, savings are actually going up, which means people are putting less money into investments because they're scared. So I think one of the best ways to show this is a video, a little cartoon that Ray Dalio put together. Let me play this for you.
Now the economy begins deleveraging. In a deleveraging, people cut spending, incomes fall, credit disappears, asset prices drop, banks get squeezed, the stock market crashes, social tensions rise, and the whole thing starts to feed on itself the other way. As incomes fall and debt repayments rise, borrowers get squeezed. No longer credit-worthy, credit dries up, and borrowers can no longer borrow enough money to make their debt repayments.
Happening right now.
Scrambling to fill this hole, borrowers are forced to sell assets. The rush to sell assets floods the market at the same time as spending falls. This is when the stock market collapses, the real estate market tanks, and banks get into trouble. As asset prices drop, the value of the collateral borrowers can put up drops. This makes borrowers even less creditworthy.
Less money in the system.
People feel poor. Credit rapidly disappears.
We didn't even talk about the inflation
Less
yet.
spending, less income, less wealth, less credit, less borrowing, and so on. It's a vicious cycle. This appears similar to a recession, but the difference here is that interest rates can't be lowered to save the day. In a recession, lowering interest rates works to stimulate borrowing. However, in a deleveraging, lowering interest rates doesn't work because interest rates are already low and soon hit 0%. So the stimulation ends.
So here's the deal. The difference in the current environment, interest rates are already high, which could help provide enough room to drop rates and stimulate growth. So how do we create what Ray Dalio called the perfect deleveraging? Check this out.
You see, a deleveraging can be ugly or it can be beautiful. How can a deleveraging be beautiful? Even though a deleveraging is a difficult situation, handling a difficult situation in the best possible way is beautiful. A lot more beautiful than the debt-fueled, unbalanced excesses of the leveraging phase. In a beautiful deleveraging, debts decline relative to income, real economic growth is positive, and inflation isn't a problem. It is achieved by having the right balance. The right balance requires a certain mix of cutting spending, reducing debt, transferring wealth, and printing money so that economic and social stability can be maintained. People ask if printing money will raise inflation. It won't if it offsets falling credit. Remember, spending is what matters. $1 of spending paid for with money has the same effect on price as $1 of spending paid for with credit. By printing money, the central bank can make up for the disappearance of credit with an increase in the amount of money. In order to turn things around, the central bank needs to not only pump up income growth, but get the rate of income growth higher than the rate of interest on the accumulated debt. So what do I mean by that? Basically, income needs to grow faster than debt grows. For example, let's assume that a country going through a deleveraging has a debt-to-income ratio of 100%.
This is very important,
That
folks.
means that the amount of debt it has is the same as the amount of income the entire country makes in a year. Now think about the interest rate on that debt. Let's say it's 2%. If debt is growing at 2% because of that interest rate, and income is only growing at around 1%, you will never reduce the debt burden. You need to print enough money to get the rate of income growth above the rate of interest. However, printing money could easily be abused because it's so easy to do and people
you don't
prefer it to
say.
the alternatives.
last
The
4
key
years,
is to
yeah,
avoid
they used that
printing
a little.
too much money and causing unacceptably high inflation the way Germany did during its deleveraging in the 1920s. If policymakers achieve the right balance, a deleveraging isn't so dramatic. Growth is slow, but debt burdens go down. That's a beautiful deleveraging.
What do you think? You think we can do that? Comment below. Yes or no? Hell, you can even say maybe. I want to bring something up that maybe all of you missed, but in 2019, we were headed to a recession. We were literally there. And then the pandemic, a little thing floating around in the air that got us sick and many people died and shut the country down, which gave the Fed and the governments the ability to just turn those printing presses on, and wow, did they ever. But what was the pain from that printing? Revert back to your life the last couple of years. There you have it. And now we need to balance this thing. So we've already printed an insane amount of money. And this administration has made it clear that they want to bring down the deficit and they want to bring down inflation. But how do you do all that? And how do you achieve what Ray Dalio calls the beautiful deleveraging? You know, for me, maybe I'm biased, but this seems so simple. I mean, it's what I teach every single day with the infinite banking concept, recycle and recapture, and that's what Doge is doing if you think about it. Recycle and recapture money you're giving away to somebody else. Doge has been doing that. And check this out right here. Here are all the things that have been secured by Doge. The Doge website also lists the contracts and leases that were canceled, so in the future, that saves a little bit more than $12.7 billion, and that's as of February. On March 4th, the website claimed 2,334 contract terminations totaled $8 billion in savings. Another 3,489 grants were terminated for roughly another $10 billion. It's kind of fun. We're just $8 billion and $10 billion. 748 lease terminates. That's $660 million. Yeah, that'll pay for that new plane. So you can go on this website and you can see it, but this is what we do every day when we teach the infinite banking concept. A privatized banking system where we recycle and recapture money we're losing and giving away to someone else's bank. No different. Because whose bank are we giving up all this money to? Someone else's bank. I kind of had a weird epiphany in doing all of this when we started talking about this recycle, recapture, and the beautiful deleveraging. Remember, in the beautiful deleveraging, incomes went up. And if income goes up, spending goes up while debts and deficits go down. So let's talk about everything we just did. Doge, right here. Every day, it's roughly $1 billion a day. Where's that money going? Well, it's coming back into the government. What have they said, or what are they trying to do? Give Americans a bonus, give Americans a check, like a stimulus check. But the stimulus check isn't from printing money and creating more debt. The stimulus money is from recycling and recapturing money that was just being given away, money that was spent terribly. But hold on, it gets even better. Trump has also talked about trying to eliminate taxes on different income groups. I think it was like 150,000 or less. They were talking about eliminating your taxes. Where are we going to replace that? Well, look at this right here. Remember I talked about tariffs. Tariffs are in the hot seat right now. They're looked at as bad, super bad, going to make things more expensive. Inflation's going to go up. But hold on. You see, I remember the 80s when Japanese cars were literally threatening the U.S. automobile industry because they were just more efficient, cheaper cars, and everybody wanted that. But the U.S. car manufacturers weren't making that. So Japan was literally dropping Japanese-made cars on U.S. soil. And what the government do is they said, no, no, no. Probably because the auto manufacturers went and complained and they're lobbyists. But anyway, nonetheless, they slapped tariffs on Japan. Those cars weren't cheap anymore because now we had to pay a big tariff. So what did Japan do? Yeah, you already know this. Toyota, where is that car made? Here in the United States. Hondas, where are they made? Here. Kias, where are they made? Here. How many jobs did that create? How much money was made? How many families get paid really well for working in those factories? Why were those factories built here? Tariffs. More proof right here. In total, President Trump has secured nearly $2 trillion in U.S. investments, and this is old. Look at this. TSMC announced an unprecedented $100 billion investment in U.S.-based semiconductor chip manufacturing. Apple announced a historic $500 billion investment that's going to create 20,000 new U.S.-based jobs. Why? Well, because Apple sent all their work overseas. Well, now overseas has got tariffs. They're bringing it back. Trump announced the largest artificial intelligence infrastructure project in history, securing $500 billion in planned private sector investments. Trump secured $20 billion investment from the DAMAC properties to build new U.S.-based data centers. Wisconsin-based Claros, a leader in low-voltage energy storage, $6 billion. Eli Lilly and Company announced $27 billion investment into manufacturing here. This one I freaking love. Saudi Arabia declared its intention to invest $600 billion in the United States. I bet you that's going to be more than that. And that's just in 4 years. Why 4 years? You figure that one out. And Taiwan pledged to boost its investment in the U.S. You see, all of these and many more are the impact of what he is doing with trade wars, with tariffs. But yeah, we're so focused on, oh, those poor Canadians and those poor Mexicans and all. Folks, you want to make more money? This is what is happening. It's going to be recycled, recaptured back. Maybe you're going to not have to pay taxes. Maybe we're going to get a check. Probably not me, but probably most will get a check. And what is that check from? The recycle and recapture. See, I had this epiphany. Are you seeing it? Now, I'm just speculating here, folks. There's no proof in this, but it sure does make logical sense, does it not? A beautiful deleveraging done different. So this right here sums up everything that I was just talking about. The White House is using tariffs to restore manufacturing, and data suggests it will take time. Well, no kidding. You can't just snap your fingers and a factory pops up. But look at this. I didn't know this. Since 1965, manufacturing, retail, hospitality, professional, look what has happened to manufacturing in this country. It has gone down, down, and down. You don't want your stocks to look that way. What has gone up here? Well, hospitality, professional services, but we've lost the backbone of what the United States was built on, manufacturing. But you see, this next round of manufacturing, it's going to be manufacturing of semiconductors and chips and all the things that we send overseas to be made, and then we just let them ship that stuff right back here. Do you see how this works? It is not very complicated. Just take your head out of the toilet and look around. It's not hard to see what's going on. You see, so I don't think I was wrong about Trump. I do think that there is a plan. I do think we're going to have to go through some pain to get to it, but he has been clear that that is going to be the plan. Couple more real quick things here. There is no way you can deny that the U.S. has been overcharged on goods and unfair tariffs in favor of other countries' economies. They are literally building their economies on the back of the United States of America. And clearly, that's why it has to change. And not only that, I hear it every day. People are complaining about not making enough money. People are complaining that they're not able to invest because things are too expensive right now. You see, all of this plays into one cohesive plan. It might not be the plan Ray Dalio laid out perfectly, but it is an attempt at a beautiful deleveraging done different. But let's flip the script. What if Trump never did any of these new policies? What would happen then? The U.S. might be beyond bankrupt. The dollar would continue to lose its value as we printed more and more and more money. The BRICS, well, they'd become even more powerful. Jobs would not return to the U.S. The recession would last way longer. Notice how I'm not saying there won't be a recession with either party. It would just last a lot longer under somebody else. Government waste would go unnoticed and not be corrected. Doge would never exist. Debts would have increased. The beautiful deleveraging, well, it probably would be less obtainable. So the question is are we better off with Trump? Or were we wrong thinking Trump would make America great again? So with that being said, folks, if you liked this video, check this one out. A message from the future, 2025. Thanks for joining me for this episode of What Now? What's Next for Trump?